Hello, my name is Sandra Schaefer. In this tutorial today, we are going to go through question S5-9. This can be found on page 155 of the workbook or in your study plan on Pearson under chapter section 5.2. This question takes us through journalizing some transactions with respect to inventory. In this question, Ontario Rise Inc. is the name of the company that we are dealing with. And this company sells $340,000 of women's sportswear to Proto, which is another company, under the credit terms of 210 net 30 on August 1st, 2020. Ontario Rise's cost of the goods that were sold is $84,000, and Ontario Rise receives the appropriate amount of cash from Proto from their client on August 10th, 2020. We are assuming in this question that Ontario Rise Inc. uses a perpetual inventory system, and the requirement is to journalize the transactions for August 1st and August 10th. Some steps to keep in mind when answering inventory journal entry questions. First of all, it's important to know what inventory system is being used, because if you're using the periodic versus the perpetual inventory system, there are different journal entries involved. In this question, it was noted that we are using the perpetual inventory system. The second thing to do is to read through the question and what is required for journalizing entries. And the third step I usually like to ask is, in this transaction, or when I'm recording these journal entries, am I the buyer or the seller? Because that will determine what types of entries are being done. In this question, it is important to note that as Ontario Rise Inc., we are the seller. We are selling sportswear. We are the seller in this transaction. So all of the entries will involve sales accounts. This is a slide that I like to use to summarize all of the different sales journal entries when we are the seller. You can journalize when you sell inventory, when inventory is returned, or when goods are returned. We can record if there's a sales reduction. In other words, our client has received damaged goods and we will give them a dollar reduction as opposed to returning goods into inventory, which is the case with the sales return. There are situations where our clients or customers may take a sales discount that we're offering when they're paying their accounts. And then the last scenario is where we have shipping expenses. Now, if you note in red, all of these transactions involve a sales account. When we are the seller, typically the transactions involve sales accounts, as opposed to if we're the buyer, it would involve inventory accounts. This last transaction for shipping is the only one that doesn't involve a sales account. So let's go through these journal entries. The first entry is to journalize Ontario Rise's sale. Well, you have to put the first thing you have to put in is a date. If the question, sometimes the study plan will give you the date already in the question. Sometimes you have to put that amount or that date in. In this case, the date is August 1st. And the debit and credit, you always list the debit accounts first and then the credit accounts. I usually in these questions, transactions, list the debit and credit accounts, and then I go over to do the amount calculations. In this case, when we are selling sportswear, the first thing that we need to figure out, are we selling it and getting cash, or are we selling it on account? Here it says there are credit terms, so we are selling it on account, which means we are debiting accounts receivable. When we're making this sale, we're not receiving cash. We're going to set up a receivable or an account to receive money at a future date. And the credit is to sales revenue. We are selling goods, so therefore we are going to credit sales revenue. Now the amount is given right in the question, $340,000, so I can record that debit and record that credit. Very critical when you're doing journal entry transactions to always ensure that your debits equal your credits at the end of the transaction. In the second journal entry, we are journalizing Ontario Rise's cost of goods sold. So the date here is again going to be August 1st. And when you're recording cost of goods sold, you're recording the expense to the company of the inventory that's being sold. So here, the expense is recorded in a cost of goods sold account, and the account that's credited is the inventory account. When you're selling goods, you're physically taking the stuff or the goods out of your inventory, and you're recording that cost as an expense related to that sale. So you're going to reduce your inventory in this journal entry and record the expense related to the sale of these goods. And the amount is given. The cost of the goods was $84,000, so we record the $84,000 debit and the $84,000 credit. In the third journal entry, we are to record the cash receipt. So this client, Proto, is paying off their full account on August 10th. And we're going through and doing the last part of these transactions. When the account is paid, first thing you want to do is determine if a discount is being used or not. How you do that is you look at the dates. The terms are 2-10. So in order to receive a 2% discount, Proto has to pay the bill or pay their accounts receivable within 10 days. So you go back to your dates. The first recording of the sale was on August 1st, and they're paying on August 10th. So they're within that 10-day window, so they can use their discount. So when they can use their discount, then the next step you would do is calculate the discount that is going to be used. We're going to take the full $340,000 that's in our accounts receivable account. We're going to apply our 2% discount from the terms. And the amount of the discount when you calculate that is $6,800. So going back to our journal entry, the debit account, well, we're receiving cash. Cash is a debit. We're increasing cash. That's easy account. Cash is usually an easy account to figure out. And I'm going to leave the debits and credits, and I'm going to figure out the rest of my debit and credit accounts. Now, when we're receiving cash, we're not receiving the full amount of the $340,000 that's being paid from the accounts receivable account. We're receiving a little bit less than that because they're taking a discount. So we're not going to receive the full amount of cash. So that must mean we must have a debit to a discount account in order to make up the full amount that we are going to credit from our accounts receivable. We set up the accounts receivable with a debit in the first transaction, and in the last transaction when we're paying it, we need to credit accounts receivable. And we know that that amount is going to be the full $340,000 because they're paying off their full account. We know the sales discount we've calculated is $6,800. And then to figure out the cash, you simply take your credit of $340,000, subtract the discount of $6,800, and that gives you cash of $333,200. When you add these two debits together, they should total your credit of $340,000. It's important to, when you're going through these questions, to make sure your total debits equal your total credits in each transaction. And that is question S5-9.